Step one, know your credit. Welcome to step one of my practical, experience based home buying series. I spent years on both sides of the table, helping buyers qualify for USDA mortgages and guiding families through the real world process of buying a home in today's market. Most online guides are generic, they skip the parts that buyers actually struggle with. This series is different. I'm going to walk you through the process the same way I do with clients, clearly, honestly, and without sales pressure. And we start with the most important step of all, understanding your credit before a lender does. Buying a home, whether it's your first or your 50th, can feel like a long game where you don't know the rules and you're not sure if you're holding the right pieces. It does not have to be that way. The biggest mistake I almost always see comes from people not knowing what's actually on their credit reports until it's too late. So today, we're going to take that uncertainty off the table. The easiest place to start is annualcreditreport.com. This is a federally authorized site where you can pull your credit reports from all three bureaus, Equifax, Experian, and TransUnion, at no cost. And yes, it's important that you pull all three. Not every lender reports to every bureau. I've had clients who thought their credit was excellent because the bank showed them a great score until we pulled all three reports and saw a very different picture. I've even had incorrect addresses show up on my own report. It's fixable, but you only know if you check. So here's a quick clarification that'll help a lot of you folks. Your credit report is not the same thing as your credit score. The report's the raw data. It shows who loaned you money, your payment history, your past addresses, and sometimes even past employers. Your score is all that information boiled down to a single number. And every bureau calculates it differently. That's why you rarely see three identical scores. And important, your credit report does not include your income, your savings, how much money you have in the bank. Lenders verify those items separately. Right now, you're not chasing a number. You're looking for accuracy. As you review each report, watch for accounts that you don't recognize, late payments that are wrong, collections that aren't yours, incorrect addresses, balances that don't match reality, duplicate debts, and accounts that should have been closed. Having negative items doesn't automatically mean no, because a one-time issue with a reasonable explanation may still be workable. Surprises, however, are what derail transactions. If something is wrong on the report, timing matters. Simple errors, like a bad address, might take a week or two to correct. Collections are different. Expect months, not weeks. Whoever reported the collection has no incentive to move quickly. And if you don't have documentation, especially for something you paid in cash years ago, it may never fully resolve. I've also seen old debt stick around longer than expected when a borrower makes a payment and unintentionally restarts the clock. And be cautious with anyone who promises to fix your credit for a fee. They're usually just submitting paperwork that you could have submitted yourself. And if proof doesn't exist, paying someone won't magically create it. When I worked at USDA, we used the mid score, the middle of your three scores, not the highest or the lowest. If one score is much lower than the others, you need to know why, because that's the score underwriting will generally focus on. Each bureau's data may be different, which is why one report may look clean while others show something you forgot about. This next part's very important. Do not open any new accounts right now. No credit cards, no quick loans, no car loans, no buy now, pay later. If you're unsure whether something counts as new credit, pause and ask. Every hard inquiry affects your score. A soft pull is a peek at your credit. It does not affect your score, and you can't be denied credit because of it. Examples of soft pulls include you checking your own credit, pre-qualified credit offers, see if you're eligible ads, and tools like Experian Boost. You do not need to pay for a numerical score at this stage. Most banks already show you one score for free. When I checked my 3 bureaus recently, they actually are showing the scores right now, but that has not been historically true. And remember, apps like Credit Karma probably aren't going to use the same scoring model your lender will. So what Credit Karma shows you probably won't match any of your 3 scores. Now, a hard pull is different. That is the official inquiry lenders use to approve credit. It will usually drop your score a few points, and it will stay on your report for about 2 years. Hard pulls happen when you apply for a mortgage, apply for a car loan, or apply for a credit card. Buy now, pay later, BNPL services like Affirm or Klarna often count as short-term loans. At USDA, we treated them that way. They can hurt your debt-to-income ratio and raise underwriting questions. Now, here's the key point. You cannot get a mortgage without a hard pull. So don't waste your energy avoiding the one that matters. Focus on avoiding unnecessary pulls now. Also, multiple mortgage pulls within a short window, generally 2 weeks or less, count as one inquiry. So rate shopping won't hurt you. You'll also hear marketing terms that sound similar but are very different. Pre-qualified means that someone has made a soft pull or you've given your lender information that they took at face value. It's useful for a conversation with your lender, not for buying a home. Pre-approval means a hard pull, documentation, and a real underwriting review. Sellers and agents take pre-approval seriously because someone has actually verified your information. You can buy a house with a pre-approval. You cannot buy a house with a pre-qualification. And you cannot get a pre-approval without that hard pull. This first step was about clarity. When you know what's truly on your credit report, the good, the bad, the ugly, or the unexpected, you can move through the rest of the home buying process with confidence instead of being surprised. In step 2, we'll take that clarity and build a real-world budget, one that lenders understand and that you can actually live with.